Well, yes, as you said, the European banking sector is quite well capitalized right now. Profitability has increased, and what you mentioned, the market adjustment in early April, was clearly not targeted towards the European banks. So this is good news, although we have seen that the funding conditions have worsened, not to historic levels, but funding costs have increased. So we still monitor very carefully, and I'm sure also the banks monitor very carefully how they're exposed to potentially vulnerable parts of the broader financial system.
But if you look at like the nexus as well between the bond markets and the banks, it's not broken, right? I mean, that's the lesson learned from the European debt crisis. And now we see wobbles in the bond markets again arising. Is that a concern?
Yeah, so as I said, I mean, the short-term adjustment that we have seen to what happened in April and also the current conditions is that banks are dealing quite well with the market adjustment. I would say that one should not only focus on the bond market, but also on the longer-term implications of what we've seen, the announcement of tariffs on banks' credit risk. So I think the short-term adjustment, as we've said, has been relatively smooth, but we don't know what is still going to come with regard to asset valuations, credit risk. So I think this is where we need very careful monitoring. The banks also need to monitor very carefully how their credit portfolios are exposed.
Yeah, you've been speaking about the fact that, especially in Europe, there was a lot of fiscal spending, a lot of help from the monetary side as well through the various crises we had in the past decades. With the effect that we don't really know the loan quality, right?
Well, that I wouldn't necessarily say. So if we look at the non-performing loans in the banks, they have come down quite significantly, and we've done a lot of work. The banks have done a lot of work to correctly assess credit risk. No? So the point rather is that we did have rather big shocks hitting GDP in the euro area in different countries, but these shocks haven't really led to losses on banks' credit portfolios because they were to some extent buffered by fiscal policy. And so the question is, going forward, if future shocks hit, would fiscal policy be in the same position to buffer these shocks? Do the banks need their own resilience? So this is why it's so important that banks are sufficiently capitalized so they can also deal with wherever the next shock may come from.
And we need strong and well-capitalized banks, and at the same time they also need to be competitive. And that brings me to the big question of whether our regulatory framework in the euro area is not a little bit too complex. At least that's the criticism. Are you working on getting it less complex?
Yeah, so first of all, I would say that actually the regulatory and supervisory framework we have in place makes the banks more competitive, because the better capitalized the banks are, the more competitive they are, the better they can provide services to their customers in the real economy, also in terms of crisis. So there's no conflict between growth, competitiveness on the one hand and resilience on the other hand. Can we get there in a simpler way? Can we simplify the way we do things? Yes, of course. I mean, it's like in everyday life, one can become more efficient, more effective, and we're actually doing a lot in order to improve our supervision in that sense, make it more efficient, more effective, but staying clearly focused on risks.
You have a task force, as much as I know, inside the ECB as well, to look at how to make it less complex. So how is work going there?
Well, it's a task force of the Governing Council of the ECB. So we have actually, over the past years, done a lot to simplify our procedures within the SSM, the single supervisory mechanism. So from the supervisory side, we contribute to that work. So this is the big reform of this supervisory review and evaluation process, which is now being implemented. And we've identified more areas where we can also become more efficient, more effective, basically spanning across all our supervisory activities.
Let's look at private debt and private capital, because it has risen, I don't know how many fold in the last 5 to 10 years, and it's not regulated. Do you think that is a reason for concern and also financial stability?
Well, we've seen indeed that non-bank financial intermediaries have gained market share, so they've grown, and one needs to be very differentiated when looking at these non-bank financial intermediaries. So this can be insurance companies that are well regulated, it can be other market participants that are less well regulated. And what we are saying is one needs to monitor the risks very carefully, because it's not that risks migrate from banks to other parts of the financial system. The whole financial system, including the banks, is actually very closely interconnected. And we've just recently published a blog in which we argue that the banks need very good risk management of their connections to private markets, private debt markets, private equity markets. So this needs to be reflected in banks' risk management. And I think we also need responses from the regulatory side in terms of better reporting of these activities and also addressing systemic risk issues that can arise in non-bank financial intermediation.
I've been speaking to Andrea Orchel early on, but also others who think that currently it's a very interesting time. We see national interests being on the rise, and at the same time, of course, you're representing the European view. How do you see that development currently taking place? Are they moving in tandem, like national interest, European interest, or are there contradictions?
Well, I don't want to comment on specific banks or their strategies. I think very generally, I think what is important now is that we seize the moment and look at what else needs to be done in Europe to really create a single market also for financial services, what work needs to be done to complete the banking union. I speak for the single supervisory mechanism, so the supervisory side. We have work that needs to be done with regard to completing the resolution framework, and we also have European deposit insurance. So this is really what we are advocating, that we should now work on harmonizing national rules, completing the banking union, capital markets union. So I think this is really key at the current moment.
Yeah, of course. But is there enough political will? I mean, currently Europe is kind of coming back as being a positive example. Money is flowing back into Europe. Do you think that renders politicians, there's enough political will to actually enact all these needed reforms?
I think there's a lot of political initiatives, and actually for some of the files that I mentioned, there's very concrete proposals that have been tabled, and I think it's our role to also contribute to that debate by providing evidence of what have we done, what are the gaps, and how beneficial would it be to close the gaps.
Okay, one last question on the timeline. What do you think, how long will it last until we get a solution, for example, on the common deposit scheme, on the deepening of the capital markets?
Well, that's a bit speculative because it's the dossiers are in a different state. I mean, as I said, there's a very concrete proposal on closing the gaps in the resolution framework, crisis management, and deposit insurance. So this, I think, could move fast. For others, it will take more time, but it's not for us to take these decisions and to push the timeline.